Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. All right, let's get into it. The date today is October 3rd, 2025.
So what's really going on with the global economy? That's the million-dollar question, isn't it? We're getting some seriously mixed messages, with some data pointing one way and other reports flashing some pretty clear warning signs. In this explainer, we're going to dig into the latest numbers coming out of the US and Japan and try to decode what's actually driving the markets. Let's get started.
First up, let's talk about the United States. And honestly, the data is just all over the map. It feels like a real tug of war is happening between signs of strength and signs of weakness, which makes it incredibly tough to get a clear read on where things are headed.
And this is the number that really got everyone's attention this week. The ISM Services PMI report came in at exactly 50.0, not 50.1, not 49.9, right on the line. A number that just screams that the economy is stalled out. So what's the big deal?
Well, think of the PMI as a kind of health check for the massive US services sector. Anything over 50 means things are growing. Anything under 50 means they're shrinking. So hitting 50 on the dot means that after a good stretch of growth, the sector has essentially slammed on the brakes and come to a dead stop. That is a huge change of pace.
But here's where it gets really dicey. When we peel back the layers of that headline number, the picture gets a lot more worrying. Business activity itself is actually shrinking. The employment part of the index is also contracting. And get this, it's been doing that for 4 straight months now. And at the exact same time, prices paid aren't just high, they're actually accelerating. So let's put that together. Slowing activity, job losses, and rising inflation. That is a really tough mix.
So the overall services sector has hit a wall, but that's not the full story. To really get what's going on, we need to look under the hood and see which specific industries are pulling things down and which are still holding up. And the S&P Global data gives us a perfect view of that, revealing a pretty dramatic split. And here you can really see that split in action. It's like a tale of two economies. On one hand, you've got the tech sector just booming, and financials are looking quite strong too. But then you look over at healthcare, and it's actually in a downturn, the fastest it seems since May of last year. This really helps explain why we're seeing some stock indexes, like the tech-heavy NASDAQ, do okay, while other parts of the market are really struggling.
Okay, so that's what businesses are doing. Now let's shift gears and talk about the US labor market. That ISM report already gave us a hint that things were slowing down, and while other data is confirming that the red-hot job market is definitely starting to cool off. Now, on the surface, the latest JOLTS report, which tracks things like job openings, looks pretty stable. But the really telling number in here is the quits rate. This is a fantastic gauge of how confident workers feel. I mean, think about it. If you think you can easily get a better job, you're more likely to quit the one you have. With that rate staying flat, it tells us that people are getting a little more nervous about jumping ship. So we had these big macroeconomic labor numbers looking okay, stable even. But that stability is just not matching up with how people are actually feeling out there on the street. There's a real disconnect. And boom, here's the proof of that disconnect. The latest consumer confidence index took a pretty nasty tumble, hitting its lowest levels since April. So what has everyone so down in the dumps? When we look at the details, it's pretty clear why people are getting worried. How they feel about the current situation saw its biggest one-year drop. The index that tracks their expectations for the future, it's been flashing a classic recession warning for months now. And remember that feeling about job availability? It's now fallen for 9 straight months, which links right back to that cooling we saw in the JOLTS data. People are feeling the pinch, and it's even hitting their vacation plans. And here's the bottom line, pulled right from the Conference Board's report. It makes it crystal clear that inflation is once again the #1 concern for everyday people. This isn't just some abstract number anymore. It's what's driving how we all feel about our own finances and the economy as a whole.
All right, so that's the very complicated picture in the US. Let's hop across the Pacific and take a look at Japan. While the US is sending out all these mixed signals, the story in Japan seems a lot more straightforward and, frankly, a bit more concerning. Things are slowing down.
The Bank of Japan's Tankan survey is a huge deal. It's a key measure of business sentiment, and it tells a really interesting story. Right now, Conditions for non-manufacturers, think services, are still quite strong. But the forecast, that's where the worry is. Both manufacturing and non-manufacturing businesses are expecting conditions to get worse over the next few months.
So even though business is holding up today, especially in services, everyone seems to be looking ahead and getting nervous. That big drop in the forecast for non-manufacturers is a major red flag for an economy that depends so much on domestic demand. And it looks like that pessimism isn't just a feeling. It's already showing up in the hard data. Japan's industrial production just fell by 1.2% in August. And this is the second month in a row of declines, a clear sign that the manufacturing engine is losing power. And we're not just talking about one sector having a bad month. This weakness is hitting key export-focused industries right across the board, from electronics all the way to the incredibly important auto industry. This really suggests the global slowdown is starting to take a serious bite. And just like we saw in the US, Japan's labor market is also starting to show some cracks. The unemployment rate is ticking up, and while it's still pretty low by historical standards, it's just another piece of evidence pointing toward a cooling economy. Okay, let's connect the dots. We've got a stalling US services sector with stubborn inflation, and we have a Japanese economy that's clearly slowing down. Now for the big question, how is all of this playing out in the currency markets? Because at the end of the day, for anyone watching the markets, this is what it all comes down to. How does all this economic data translate into actual price movements, especially for something like the US dollar versus the Japanese yen? And wow, the story in the foreign exchange markets over the last week could not be any clearer. The US dollar has been the undisputed king, the strongest currency by a mile. And at the very bottom of the pile, you have the Japanese yen. The euro and the pound are just sort of stuck in the middle. That divergence is absolutely dramatic. So what's behind this huge move? It really all boils down to the central banks. In the US, even with a slowing economy, that sticky inflation is keeping pressure on the Federal Reserve to keep interest rates high. That makes holding dollars attractive. In Japan, it's the complete opposite story. A slowing economy means the Bank of Japan is likely to keep its super easy money policies in place, which weighs heavily on the yen. This massive split in policy is the engine driving the currency markets right now. So that's the lay of the land as we see it today. But the markets never stand still, and we have a few major events coming up in the next few days that could shake everything up in a big way. As we can see from investing.com, all eyes are going to be on the US this week. We'll get some insight from the Fed on Thursday for sure, but the main event, the one that could move every market, is Friday's jobs report. This is the big one. It's probably the most important economic number we get each month. And that brings us to the final crucial question. The market is betting on a strong dollar because of a US economy that's cooling but not collapsing. Will Friday's jobs report confirm that story? Or could we get a surprise number that completely reshuffles the deck and changes the entire narrative? That's what everyone is waiting to find out. Thanks for watching. Don't forget to like and subscribe, and we'll see you next time.